Thank you very much for joining us.
Pleasure.
And would you like to tell us what brings you on stage or what's your experience in the steel derivatives and hedging space?
Okay, so I started off as a physical steel trader in the mid-1980s for STEMCOR, running around Eastern Europe and the CIS, moved to the Middle East, spent 10 years there with them, and ended up with Trafigura, heading their ferrous business. So on the physical side, I've got that. For the interim, I was 12 years an investment banker and worked in derivatives trading as global head of steel at Standard Bank, which introduced me to China a lot. Spent a lot of time developing derivatives in China, so the Shanghai suite and the Dalian suite, based on the work we did back at Oxford. And for the last 10 years or so, since helping your team develop the current suite of ferrous contracts on the LME, we've been introducing parties to help trade them, understand them, deliver project finance, trade finance, and build liquidity on that contract. So it's a physical and derivatives mesh that we have.
Thank you very much. And Philip?
I began my career with Metal Bulletin, as it was known then, a trade industry publication around the time when steel derivatives became a consistent conversation and then a real thing that you could trade. I think that was back with the launch of NYMEX hot rolled coil futures and the London Metal Exchange's first contract in the space. And through that became something of a specialist, I suppose, in terms of the development of those instruments. And that took me into the industry. Like John, I spent quite some time working with STEMCOR, one of the world's renowned steel trading companies. And the intention of working there was to integrate the use of derivatives across STEMCOR's business. So focusing first on the US market, I worked a lot with strip mill products. Then with the development of iron ore futures, looking a lot at our Asian business with STEMCOR at the time, and then also globally with the LME's instruments. That took me into the development of liquidity around those instruments. I co-founded a firm called Ferrometrics as liquidity in those markets started to develop. And our primary focus at Ferrometrics was market making. So creating liquidity for people like you in the room to use those instruments so you could come onto the exchange and find a bid or an offer. That work took me back into the physical industry itself in order to resource liquidity and bring it into the paper markets. We tried a variety of different mechanisms, but the most successful of which ended up being in steel scrap. And that approach to the market, to developing liquidity, took me to a company named Anglo American, where we established a steel scrap operational capability around derivatives trading techniques. And that business developed over about 4 or 5 years, became a company known as Adelphi. Adelphi was sold at the end of last year, and we've been focusing on the transition of Adelphi's management to its new owners, Global Ardor Recycling. And I now find myself a couple of weeks into our newest venture, Pool, which is a company we've just founded that is focusing on helping companies who want to adopt price risk management techniques and other, should we say, innovative capabilities around their supply chains to integrate them into their business. So that's what we're here to talk about today. Well, and anything else you might want to ask us.
No, thank you very much for joining this panel. And my first question was going to be about the evolution of these markets over the past 10 years. But before we jump into that, I went through the attendee list of this IREPAS event, and I counted at least 30 companies that have been active on our steel derivatives markets over the past 3-4 years. So that's a pretty impressive number. I'm sure many of them are not in the room right now because many of them probably are at the bar chatting or whatever, but 30 companies are just at this event. So I think that is something we would have not believed even just a couple of years ago.
Absolutely.
So how have you seen in the past 10 years, since the launch of the steel scrap derivatives, acceptance of risk management in the industry evolve?
From what we've seen, and our focus is really in the MENAT area as opposed to European area, we've seen a modest take-up with some highly advanced parties, which we've been involved helping build their desks out and build their risk management structure. We found the banks trying to pull steel traders and the steel producers and the main contractors into this space because it helps the banks lower profile of risk on their business. So the banks are very, very supportive. It's just a challenge to bring more of that liquidity across. So there are some islands of excellence who really do understand it, the 30 or so companies here, but there's a whole swath beneath them who can be elevated to participate in this industry from a hedging point of view or certainly from a speculative point of view.
Okay.
I think there's been sort of a perception amongst the industry that there's a lot of resistance towards the use of like techniques around steel derivatives, but I don't think that's actually the case. I think what we've seen over the last 10 to 15 years, where this has become an actionable concept as opposed to a theoretical idea, is a gradual bridging of the gap between the way companies have managed risks historically without these tools and now these new tools being available. And that's not an easy transition because the companies that we see here at this conference today and others in the sector have been successful despite not using steel derivatives. Whereas you look at comparable businesses in sectors like base metals, they've had these tools available for a long time. And that shift isn't an easy one, particularly if you're looking at a company like a steel mill, where you've got multiple elements to the business, multiple silos, operational, commercial. Bringing all of that together is really, really difficult. And what I would say over the last 10 years is that willingness to kind of look at how that might work, how that might integrate, is just growing and growing and growing. And in the last couple of years, we've seen like a sizable change where people are willing to have that conversation about the use of tools like this and other risk management tools, not just in the commercial team, but across finance, treasury, and that's what it takes. So that kind of growing acceptance that this is going to be a whole organization approach. And I think, we're at a good stage for that integration work to kind of accelerate from here. So I expect, hopefully, next time we meet, there'll be more than 30 companies on the delegate list who've traded.
Perfect. And in terms of size, do you think these markets can support the requirements of real businesses, of real companies with real economic size exposure? Because one comment we often hear is, oh, it doesn't trade enough for my company, there is not enough liquidity for my company, but without disclosing any names, have the companies you've been working with been able to hedge cargoes, to hedge accumulation processes, to hedge their actual business and not just have a little bit of a play on the side?
Without question, the answer is yes. If you look at the screen and trading on the screen, it's been limited. But in the telephone market, which is one of the fantastic elements of the LME, it's accommodation of a telephone market. We've frequently been able to put away 30,000 tons in an afternoon.
Okay.
Right, so that volume is there. And for longer projects, such as, we're talking about housing now, how to get financing for housing for the 2 million houses to build a year in Europe. A lot of the private contractors want stability and certainty in the price. Alex, can you bring certainty in? Yes, you can bring certainty in. You're building 40 houses or you're building 70 houses or whatever the project is. You can put a 1-year rebar price on based on scrap or based on rebar contract. The bank will finance that more easily than they will if they have to face an uncertain monthly contract. So we can see volume there from project finance, from trade finance, single deals. The volume is there. It's mostly in the telephone market, not on screen. But that particular marketplace is available and we can help you, or Phil can help you, provide the tools and the access routes to find that liquidity.
Yeah, I would just add that I completely agree with John in that we've been there, we've done it, we've found the liquidity, and it hasn't been the challenge that we expected first time around. And from then, we've just seen more and more possibility as a result of it. And the one thing I would say is the only way to sort of answer that concern for yourself is to try. And I know that sounds somewhat trepidatious, but that's the reality, as we all know of business in general. Is at a certain point you have to come out of the classroom and start actualizing.
Perfect. And John, you especially mentioned trade finance, banks, financing, which is one of the topics on this panel. And unfortunately, we were planning to have a trade finance banker as well joining us, but he had to drop out because of family issues. But that has been a big development that I've seen in the industry last year, when some of the Swiss banks and Dutch banks have started doing financing trades on steel scrap, on European hot rolled coils, on rebar, on the basis of the clients hedging their exposure.
Absolutely. Yeah. This is what I said at the first introduction when I moved into banking and I saw this happening across the base metal suite. Then we got going with the iron ore contract. We were very early developers and participants in that market. And then when I moved into Trafigura, you see the physical business and the derivatives business is so intertwined. And Trafigura is a major lender to commodity trading, and so are its peers. Your Vitols, your Mercurius moving into metals now. This is how they structure themselves. They will lend money if your risk is managed, if your project risk or trade risk is managed. They'll lend money at a cheaper rate and more of it if you're risk managed. So we can set up all the agreements, tripartite, between the lender, the exchange broker, and the borrower. And these agreements help fuel access to more capital at a lower cost to deliver your trade or your projects. So it's absolutely a marriage that we strongly support as one of the key pushes to make these markets take off. And we've seen it across the world. In the US, we've done an enormous amount of work in China on this, and in Singapore around the iron ore contract that Phil mentioned. So it's there to be done, and we just help to facilitate that with our client base.
Yeah, again, I concur in that. My experience has been that banks are far more willing not just to look at like depth of lending, but also flexibility of structure when price risk management is part of an underlying business. So things like ABL, RCF kind of financing, which is more flexible money than a kind of traditional bilateral lending facility. All of that is much more interesting in my experience, not being a banker myself, to trade finance teams. And I think there's a definite interest for certain banks that are kind of quite big in this space to focus on businesses that have that in place. So it's definitely something from a treasury perspective that I would recommend.
I'll just add in, it's also helping finance a huge amount of the trade out of China and Asia, which brings that steel into this part of the world. It's major over there. And it's time for the European banks they're ready to step in, but we need the combined industry, the off-takers and the sellers to do so along with them.
That's 100% true. And one thing we have seen is the willingness to finance material they were not willing to touch before.
Mm-hmm.
Absolutely.
So we have heard...
Particularly so in scrap.
Yeah.
Because banks were generally a little bit wary of scrap and the integrity issues, but now when you've got a derivative instrument around it, there's more support.
Yeah, so we have heard of banks looking at financing stocks in feeder yards, for example, that is not yet sold. It's going into an accumulation, it's going into a cargo, but it may take a couple of months to move, and they're looking at financing that sort of material as well.
Yeah, they just need to know what the value of that's going to be in a month or 2 months' time, and they can see that on the curve.
And on which banks are active, personally, DLME, we've been engaging with probably 12 banks so far, to see whether they offer these products or not. And I think 6 or 7 are active already. Certainly, they're starting small and they're starting with, their best clients that, are already doing the hedging, but it's something we can see bring in working capital to the industry, I think, over the next couple of years.
For sure.
So, Philip, would you like to walk us through an example of a tripartite financing agreement? How that works?
If that's not a leading question, I've never heard one before. But I bear in mind that every scenario is unique, and more so you see banks are looking at bespoke opportunities. But essentially, tripartite lending, tripartite structure enables a coordination between the underlying lending bank, the customer, and also the FCM, Futures Commission Merchant, or the institution offering access to the underlying client to clearing. And that tripartite relationship enables a kind of smoothness of communication between those three entities that makes the drawdown of funding the most efficient. So what do I mean by that? Your trade finance bank, if you're hedged, and has access title to your corresponding hedge, is very likely to be willing to provide a larger utilization of funding on a percentage basis, so a smaller haircut on the underlying commodity. if they know that that hedge is in place and they have sight of that hedge, and eventually, if they need it, custody of that hedge, which can be achieved through this tripartite lending structure. And that doesn't just mean reduced haircuts. In some cases that I have seen historically, and that would need testing in today's highly volatile environment, but historically, we've actually seen some trade finance banks being willing to discard altogether the requirement for a security haircut funded out of equity of a business and finance 100% of the underlying inventory. But if there are any trade finance bankers in here right now, I imagine they're priming their sniper rifles. So that's
perfect. And we talk a lot about hedging, about risk management, about the responsible, grown-up, adult way of using futures. But there certainly is a segment of the market that wants to use these markets to express a view. What do you think are the advantages of using futures to express a view than, for example, buying a barge of scrap or just buying physical material?
It's really quite straightforward. It's leverage. Okay, so if you had access to, let's say, 1,000 tons on the 27th of February, and the war broke out a few hours later when the LME market opened up. Wars are inflationary, so you'd say, right, I think the price of steel is going to go up. I've got 1,000 tons, that's $400,000. I don't have $400,000 to buy steel or scrap, so I can buy some scrap futures. I only need 15%, that's $60,000. Price goes up, what, 24 bucks, something like that. Let's say you make $20 a ton. You can then get that on 1,000 tons, that's $20,000. So you've used $60,000 to make $20,000 in 4 weeks. That's a 33% return on your initial investment.
Or you may lose 20 grand.
You may lose your 20 grand, all right? But the ability to express a view is so much easier because of that leverage factor. It's very difficult to express a view on 1,000 tons of physical because you have to get everything on in line. You have to get the barges, the boats, the stockyard, the integrity, the inspection, customers. You can just go to LME, make a view there, express that view. And we see an awful lot of that happening amongst trading companies in Asia. We have a strong client base there, and we think the same pragmatic approach is that we're hedging our physical, because that's the way to cheaper finance, that's the way to a more balanced, risk-astute book. But we can also use our skill sets and our, I wouldn't call it inside information, but they're in the physical market, right? They get the physical price earlier than the PRAs do, than Platts or SteelOrbis or Argus. You guys have that information. It's in your portfolio before anyone else gets it. And you can take a view on that information. You're learning something from the market. You can express a view on the LME product. And yeah, it's about leverage and access. So you can express views. And, you know, we see the hedging versus speculative activity in China. It's something like a 35-to-1 ratio. 35 times more speculation than hedging. But because the hedgers have access to the liquidity, because of the speculation, it's very cheap to execute hedges in Asia. Okay. So when you try and get that balance right, that's, you know, many of these companies are privately owned companies. You can do this, guys. If that's what you wish to do, there are ways and means to access these markets and express your views.
And I guess that not being a physical product, you don't have the risk of radioactive material, of having to find a buyer, being stuck with logistic prices that may be through the roof, or the risk of being exposed to a claim after you sell it, right?
Yeah, you've got complete integrity of your other side because of the clearing mechanism through the clearing house, which means that your counterparty risk is not your scrap buyer or your scrap seller or some intermediary. It's a clearinghouse, which is an enormous financial institution, and you're only ever exposed to 1 day's risk. So I think it's 140 years the LME has been around. How many contracts have been defaulted on? 0.
I think
148 years, and some counterparties have defaulted, but they didn't.
The clearing system has come in and stepped in. So no counterparty to that party's default has ever lost money.
100%.
I think just to add to that, and I think it's an important example of exactly what John's saying. At Adelphi, we were preparing a 30,000-ton steel scrap cargo every 4 to 6 weeks. Doing that for an operation in South Wales, collecting from all over the UK. That meant we had, on average, 40 to 60,000 tons of inventory, either sold or unsold, sitting on the dock at all times. Inbound lorries, 10 to 20 a day. There's a lot going on operationally. There's a lot going on commercially to make all of that happen. And from that activity comes a lot of insight into the marketplace. You understand the movements of where the product's going. You understand why it's happening and the competing markets, domestic, containerized traffic, all of these things. But expressing that view through that underlying physical business is almost impossible if you run it efficiently, because you have to turn your tons. Then there's the LME venue. You can sit there with a highly correlated marketplace that offers additional opportunities on top of expressing your physical view from the forward term structure, contangos and backwardations. And exactly as John says, we can go into a meaningful position or a conservative position very easily and come out of one very easily without disrupting the underlying business. That to me is like the biggest attraction for a physical business that's active in that space to start expressing a view using something like the LME, because you're not changing anything. You're not disrupting how you run your business, which you already do very well. You're just making it better. You're adding another lever, so to speak, in terms of how you engage with the market. Sorry,
just to tap onto that, if you look at the big physical traders across the metals world, but also in agris and oil products, dry bulk, they might make 20 to 30% of their EBITDA on physical. They make the balance 70, 80% hedge, speculating derivatives, because they have knowledge of the physical marketplace. They use that knowledge to speculate, and that all goes into the big pool. So they hedge where necessary, the physical, and then speculate with knowledge. And that's how you make money.
Well, and the combination of the two allows them as well to bring financing models or business models to the market that wouldn't be able to sustain otherwise.
Absolutely. And some of the reasons that
contracts, optionality, prepayments, financing.
Absolutely. And because these major trading houses are almost able to borrow money cheaper than some of the banks that they work with, because their physical book is not risk-free, but it's hedged to a significant extent, which lowers that risk, and they're able to make that money work very hard throughout the year. They churn that money, and that creates a big trading company. Right?
Can you imagine a multi-year, multi-billion-dollar offtake agreement in the steel industry with no hedging?
No hedging. Impossible.
Yep. Yet that is the normality, the day-to-day of oil markets, for example.
It is.
Right, I think we are getting to the end of the panel, so we'd like to open it up for any questions. Please, Murat.
Thank you very much. Obviously, scrap is getting more importance in the steel industry. It's becoming a strategical raw material with the involvement of this green steel initiatives, etc. How important do you think the LME contracts would, in terms of playing a strategic role when this green steel initiatives evolve?
So I think it will be important for bringing stability to the industry. As demand for scrap increases, that could bring added volatility in. And one thing that we're introducing to try to support this transition is longer dated tenors. So at the moment you can hedge on the LME only 15 months in the future. We're increasing that to 36 months by October. So it will be possible to do a full hedge for the next year or even the year after. And that will allow for longer term planning and to ensure, for example, that when new EAFs are built, costs could be, for example, locked in for the long period. And we're trying to do what we can to support.
Yeah, I can complement that because of product coming into the EU. You've got the CBAM issue now, as everyone knows, and there'll be more about that later. But identifying your CBAM, your carbon costs going out 2 and 3 years, which you can do quite comfortably on carbon that goes out 6 years, the LME doesn't go out as far. So if the LME can express that into 3 years, and you can express your carbon, and you can lock in both prices for 3 years with no risk, it's secure. And then you can turn around to your financing and say, yeah, my carbon price and my steel price are locked in. That enables the attraction of more competitive funding to that particular project that you'll be doing there. So, carbon is not hedged on the LME, it's hedged on a different exchange, but we can provide access to both at the same time. So if your introduction into this is, let's look after the carbon price, that's fine, because you can get the LME later, or you look after the LME, we'll do your carbon price later, or you can do both together. So this sort of development of these markets, I think is highly productive for people who have not only steel price risk, but carbon price risk on their exports into Europe or their imports into Europe. So you can manage both these days.
I think absolutely agree, but I think there's another element as well, is that as green steel becomes a bigger and bigger thing in financial circles, you see more and more institutional interest in investing in the underlying commodity and exposure to that commodity. And that's not generally through equities. So you see the likes of hedge funds, CTAs, who want to participate in the price of the materials that are going to be affected by the green steel revolution. Of course, scrap is there amongst all of them. And we have, over the past 1 to 2 years, seen a big shift in the way liquidity's developed, particularly on the LME steel scrap contract. And this is anecdotal information rather than official, but around longer-term structure interest to buy and sell scrap in large volumes to match a broader commodities basket that someone in, for example, a hedge fund is looking to participate in. And that is a really exciting opportunity for the companies in the sector to participate and to get involved in that market by virtue of that renewed interest, because what you tend to find is that their interest is solely in the financial instrument, and they're prepared to pay a bid offer spread, quite a big one, to come in and out of the market. What that means is, instead of selling spot, for example, your physical underlying commodity, you could hold it for a small period of time and be paid a higher price on the financial instrument for that material that's well above the cost of carry, the cost of borrowing money to hold that material. So it's just, again, it's adding another opportunity. So the green steel revolution, any shift that the kind of broader world around us sees as beneficial, is going to attract more interest in the sector, and that sector can be manifested through derivatives, and that brings opportunities for everyone sitting in this room to take advantage of, in my view. Time for coffee, I think.
If there are no more questions, I guess it's time for coffee, but I would just like to give a quick reminder that on 12th of May, we will be hosting a webinar on steel scrap markets, where the speakers will be also giving their views on market forecasts. So you can find that on the LME website. Don't forget to tune in. Thank you very much, guys.
Thank you.
Thank you, Alberto.